presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compaq Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello, everyone, and welcome to the Compaq Market Update. I'm Mo Ansari, President of Compaq Asset Management, and this is for June the 21st, 2023. Again, if you want all the broadcast and all the YouTube updates and all of the newsletters that go out, just go to compaq.com/media. That's this right down here that you can go and sign up. At the bottom, you can see that compaq.com/YouTube and get all of the information. All of it is free. Plus, you can get the app, download that to your iPhone, and you can get the daily broadcast that I do. It's the daily 1-hour broadcast, and then you can get a daily update. I'm going to talk about the Fed. Obviously, Mr. Powell was in front of the Senate today doing the biannual Humphrey Hawkins testimony that he's required by Congress to give. He gave that, and he talked about raising interest rates. We'll talk about that, where the market is, where the economy is, look at the technicals and the week ahead. So let's start with the Fed. If you look at the core inflation versus Fed policy, typically the CPI well below the Fed fund rate before pauses or cuts occur. So if you're looking at the Fed fund rate, which is CPI is at 4%, Fed fund rate is at 5%, that's when the Fed usually stops raising interest rates. As I said a couple of weeks ago, I thought the Fed was going to pause or skip, and that's what they've done. But now they're talking about raising interest rates again 2 more times. And that was a change in the dot plot, which was a little bit of a surprise to the market, that they are going to raise interest rates 2 more times, once in July and once in September. I don't know if they're going to do that or need to do that. That is the question. Is they need to keep slow down the economy? Why? Do they want unemployment to go up? Yes, they want to slow down the economy, slow down inflation, but inflation is down to 4%. They want it down to 2. That's the mantra. And you've heard me talk about this for the last couple of years, that I believe the Fed will let inflation run hotter, even though they'll keep on talking about 2%. But if it's at 3, 3.25, 3.5, they'll say, we can live with this inflation. We are fine. We do not need to kill the economy. That's a decision the Fed will have to make. I think over the next 3 or 4 weeks, we're going to see a lot of hoopla, just like we heard about the war that was going to kill the economy. Then we heard about the inflation was going to kill the economy. Then we heard about something else that was, we saw the recession for the last year and a half that everybody's going to, has been looking for, is going to kill the economy. The debt ceiling problem was going to kill the economy, and the stock market. Well, the stock market just hit 4,400. It just continues to go high. I believe it's stretched, and we'll take a look at the technicals in a little bit. But again, the next mantra over the next 3 or 4 weeks will be, oh my God, the Fed's going to raise interest rates in the July meeting, and that's going to put us in a recession. We need to slow down. The demand is still there. And as you've heard me talk about on the daily radio broadcast that I do every day for the last couple of years, as long as the unemployment is low, bringing demand down is going to be difficult because people are still continuing to spend. And as long as they have a job, they can put it on the credit cards, they'll continue to spend. And that's what we are seeing across the board right now. Unemployment is starting to soften a little bit, and that's what we're going to see. Fed cognizant of premature loosening of funding, they don't want to bring inflation down and heat up the economy. That's why I don't see any cuts. You've heard me talk about since last year. I do not see any interest rate cuts later on this year. The market was expecting that earlier on this year. It didn't happen. And now the market is coming to the realization that the Fed might raise rates. I don't think they need to do that too much more. I think we are going to see a gradual slowdown in the economy in the latter half of this year, but they might continue to do that. The market, long-term market reaction to Fed fund rates. Here's the Fed fund rate. This is the 10-year yield, and you can see the economy. It has been doing okay since the Fed has been raising interest rates. Market PEs are right here now. They are exaggerated, but they're nowhere as high as they were at the end of 2021, or as this was 2020. We're nowhere that high. We're starting to come back up from the depths where we were last year, but we are fully priced. Looking at the economy, you can see last year, We talked about it last July, nearly a year ago, when inflation was 9.1%. Everybody was running around here on fire. Inflation is going to kill the economy. And what you heard me say is, I think inflation has peaked. And that is exactly what happened. From there, we can see the CPI. You can see this is the core PPI. And the dark line is the core PPI. That's coming down slowly because a big portion of the core rate and the CPI is rents. Rents have been going up, and once you sign a lease, you don't bring it down. But we feel in the second half of this year, rents are going to start coming down too, and that will put more downward pressure on the inflation number. And that's why I think the Fed should stay, but we don't know if they will do one more interest rate. The labor market is beginning to see signs of jobless claims. They hit the highest we've seen since 2021. It's up about 35% since January, the number of people applying for unemployment, but still dramatically lower than where we were in 2021. So we think that the market is starting to soften. The labor market is starting to open up a little bit. And if that happens, and we see unemployment even going up even slightly, that will, I think, bring a lot of people to slow down spending and get a little bit more concerned about where they're going. I will be on the 27th. Next week, I'm going to be in Scottsdale. Last seminar for the summer, probably I'll be gone for the next couple of months. So if you want to come and attend, this is your opportunity. Very limited capacity there. So make a reservation. Go to compact.com/seminar at the bottom, and it's absolutely free. Then on the 25th of July, I will be in San Jose next month. Looking at the technicals, this was the number that I was looking at, somewhere around 44.50 to 45.30 or so. This little window. This is a projection from here that the fifth wave high that we saw last August. This is the projection we got. 44.50 is the target on the upside. We hit about 44, 48, 49 right there, and that was it. And from there, also it's a fifth wave high. Once we see a fifth wave like we did here last August, we do see a pullback or a correction like we did here. I don't expect that big of a correction. The 20-day moving average is about 4,300, and then we are about 4,200 is the 50-day. I think we could get a correction down to the 4,200 over the next month and a half. Summer doldrums, weak seasonal tendency, everybody talking about and the fear that, oh my God, the Fed's going to raise interest rates. Well, they've been doing that for the last year and a half. Market has still done okay, but there will be some fear coming in. And people who missed this when they got out last March when we were 3,800. We've come up straight up to 4,400. So we've gone up 600 points from this low that we had just in March. So a little bit of a pullback, a couple of hundred points. Everybody that missed this rally, that was waiting for the world to end, realized, oh my God, the world is left without me and my financial future is ending. So I better run in. And they bought at this 4,400. Usually the market comes down about 5-6%. That's a pullback that those people, again, panic, get out. And that's the opportunity for us to pick up some of the stocks. If you have the right allocation, you have your portfolio set, don't fix it. It's doing well. It's going okay. We might see a little bit of choppiness over the next few weeks, but you're going to be okay. Here's a weekly chart, and that has turned up. Once you see a fifth wave top, then you see an A, B, C correction. This is A, this is B, this is C. So we've seen this correction, but it looks like we're starting a new wave count to the upside. Next resistance is right here on the weekly charts, right here, which is about 46.37 or so. That's the next resistance. Are we going to get there right away? I don't think so, but we could get there by the end of the year. If this is wave 1, 2, 3 usually goes up quite a bit. And then we have a pullback for wave 4 and 5. This is each one of these vertical red and green lines is 1 week of trading in the markets. NASDAQ, again, target was 13,650 to about 14,000. That's this window right here. Again, the Fibonacci projection from this high that we made last October. So it gave us this target, and that we got to 13,800. Today we're trading about 13.5. First support 13.2, then 12.6, 50-day moving average. Again, I think we're going to wiggle around here for a while and come back towards 12.6. About 1,000-point decline in the S&P would not surprise me. We've come up from 10,000 to about 14,000. So we could get some kind of 1,000-point pullback would not. And I think that'll be an opportunity. Plus, it'll get people who've gotten too bullish. We usually get bullish at the top. People who buy the tops and sell the bottoms, all those people need to go through this correction. Weekly NASDAQ, again, this is the dot plot. When the dots are up market, this is the market. These are the dots right here. When the market is above the dots, we're in a bull market. And you can see that this dot plot turned up at just about at the beginning of this year, had a little bit of a pullback here, and now we're back up. That is 11.7, the dots. So we're way away from that. Pullbacks, if we do get a little bit of a pullback, and then we can go, this is the 14.6, same high that we saw in the S&P at 4,600. That's 14.6 right here. But we might see a pullback before we get there. Interest rates stuck in a range, going back and forth. I think we'll continue to see that for a time. I don't think interest rates are going up or going down dramatically in the short term. Gold, we see the fifth wave top right here at 2030, 2085. As you heard me say then, I think we made our top. We're going to get a pullback. And here we are. If we break below 1931, that is the support, then the 200-day comes into play, which is about 1850. But it's going up. By the time we get there, I think 1900 could be a good number to look at. And we're at 1945 today. We did break this slightly today. 1929 is where we got to today in gold. I think gold isn't getting in trouble, and we could be headed towards 1900 or lower in the gold market. Those are my thoughts. Those are my views. That's where looking at the week ahead. I think we're going to get some more testimony from Congress, and then we're going in the summer doldrums. That's where we are. If you need help with your portfolio, go to compact.com and set up an appointment. Come by the office here in Newport Beach. Come by the office in Scottsdale, or wherever you are in the world. You can set up an appointment, and we can do that for you. But you have to do it. Go to compact.com/seminars if you want to come to the seminar in Scottsdale next week when I'm going to be there. Or you can always stop by here in Newport. I'm always here to help you. Have a wonderful week. You've been listening to Market Wrap Update with Mo Ansari. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moez Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.